Hello, this is a quick summary of what we did in class on February 6th, the evening of February 6th, in case you were not able to be there and see this as we went together. So here's kind of a review. So we talked about building these, and we started actually with blanks and started from scratch with nothing available. So on the income statement, we want to start with income statement. Whenever you're preparing financial statements, we have a revenue, cost of goods sold, and this is very summarized because I want to focus on the structure, not on the detail, and subtract expenses. And then we have gains or losses, or sometimes you'll see it called other income, that sort of thing. And because it's a loss, it's going to be in negative. Most companies combine all their gains and losses into one item on their income statement. All of those need to happen before we calculate tax expense. Now, for this scenario, we're just going to, and you'll see companies, financial statements with subtotals. They'll have gross profit. They'll have income before taxes. That all those are optional. They make it many times easier to use, but in order to make it so you could see it all at once, I did not put that on here. So just realize that those could be also available on as part of your income statement. So we get to net income in this case, and you've subtracted out the tax expense, and then you calculate, this required disclosure is earnings per share. That's the net income divided by the number of shares outstanding. So in this case, we took the $12, we calculated on the income statement, 12 million, whatever you want, and divided it by 10, which for right now, our shares outstanding, you would be given. We will learn more about that in a later week in our course, but right now that'll be given to you. So that's how earnings per share is calculated, and that is now required. So just make a note that income statements from now on involve earnings per share as the last item on the income statement. Now, going back to these two things, these are what we call two special items. They both should come before net income. All right, so they would be inserted in here if they apply. If they don't apply, then you wouldn't see them, and your income statement would just look like this. So discontinued operations is when we have sold off part of our business to the point that we are making a shift in our strategy. All right, so it has to be a shift in strategy, and the discontinued operation number that's going to be here is the net income from that part of the business that's being discontinued. Now we have an example of how you might break that down in your practice. But the best way to typically do that is to really build yourself two income statements, one for the part of the business that's being sold or has been sold, and one for the part of the business that's being kept. And separating it into two income statements. The income statement for the part of the business that's being discontinued gets summarized into one number after taxes and after tax expense, but before net income. And then non-controlling interest is the amount of money that is earned on behalf of the shareholders that are not in control of our subsidiaries. So when we buy a company and control it, all we need to control is 51%. If we own more than 51%, we control the company, and we put all of the revenues and expenses from that company on our income statement. However, we are not entitled to all of the net income only the percentage we own. So if we own 80%, the other 20% of the company's net income is referred to as non-controlling interest. So we take that out before we get net income. So in class we used example of General Electric as a company with this income statement structure. So here's our revenues, expenses, of course, far a lot more detailed than what we were using as an example. Other gains and losses, other income, and then we get earnings from continuing operations before taxes. All right, then our taxes, and again these are subtotals. The ones in bold are subtotals that I mentioned that could be included. Continued operations. If you see the term continuing operations, that means that there's going to be some discontinued operations. So General Electric is getting out of the finance business. They are selling off their finance businesses, and the finance businesses income or loss is right here. The businesses that are continuing, the part that is continuing is up here, you know, in regular revenues and expenses. But this is the summary of all of the financial parts. Now notice it's every year, because to make this comparable, we have taken out, even though the sale of these businesses happens in 2018, this year, we take it out of all 3 years. So all 3 years that we're presenting here have the revenue and expenses from the finance parts of the business taken out and summarized down here. So you can easily see the trends on the continuing business. So this is continuing operations up here. This is discontinued operations. Okay? Then they have net earnings, net income, and then the non-controlling interest. This is the part that isn't other shareholders, the non-controlling shareholders in those businesses where we don't own 100%. This is what they earned or lost on their part of the business. And then they have preferred dividends we're going to ignore for right now. And you can see down here a little further the earnings per share. Net income divided by the number of shares outstanding as a required disclosure. So that's what it looks like in a real life scenario. All right, so we'll go back to our simplified and go on to our statement of comprehensive income. If we're building this, the net income is where we start. So these two are going to be the same. And then there's a section called Other Comprehensive Income. And the list of items that could be included in that is part of your, is found on the Brightspace, our course shell. There's a list in the codification of potential items for other comprehensive income. If you don't have any of those, and every one of them is a little bit unusual, none of them are like routine transactions. If you don't have any of those, then you would not have a statement of comprehensive income. So you have to have something in this other category, all right, to need this statement. So in this case, we had one gain, okay? So then we total that. And I know that seems redundant, but I want you to get used to the idea that there is a total if there's more than one item. Then you figure out what the tax is, because while this is a gain, it does not come on the income statement, so therefore there is no taxes calculated. So we're going to calculate the taxes here and then get the after-tax other comprehensive income. That number plus our original net income. So this is all just other comprehensive income. So net income, other comprehensive income, then comprehensive income. So that net income, other comprehensive income, and comprehensive income, 16. 12 plus the 4 equals the 16. All right. Those numbers are going to flow into our statement of changes in stockholders' equity. We have this statement has a column for each of the items on our balance sheet in the stockholders' equity section. So in the stockholders' equity section of the balance sheet, typically have common stock, additional paid-in capital, retained earnings, and now this new one, which is accumulated other comprehensive income. Now I just made up some numbers to go in here, but the net income comes from the income statement and changes retained earnings. A net loss would make retained earnings go down, net income makes it go up. But here's the thing to remember. The after-tax other comprehensive income goes here in the AOCI column, which means we're going to have an AOCI account on our balance sheet too. But that's for next week. All right? So that is where that came from. So two columns come from two different statements. Notice what doesn't go anywhere. This comprehensive income total does not go to either place because the 12 goes here and the other goes here. All right. Now, we talked a little bit also about gains and losses. So our example was stock in ABC bought for $10, end of the year it's gone down to $9. That's what we refer to as an unrealized loss. Because it is stock, it doesn't matter if we sold it or if it's unrealized and just went down. That belongs on the income statement, so it would change our gains and losses here, which then would change our tax expense, net income, earnings per share, and their net income over here. Does that make sense? So that's how that unrealized loss. Unrealized loss, anything to do with stock investments in another company. And this is us buying stock in another company. We're the XYZ company, we're buying stock in ABC. Now, if we buy bonds from ABC, that's a debt security, all right? That situation we bought for $10, end of the year it's $11, okay? So we need to record the gain here, the unrealized gain. Now we first thought as well it should be on income statement, but this situation is these bonds are going to be held for a foreseeable future. They're what's classified as available for sale. Which means when we have this unrealized gain, and remember we record this gain by debiting the bonds or an allowance account on the balance sheets. We make the balance sheet go up by the $1, and we then have this $1 unrealized gain. And because they're held for a long period of time or available for sale and they're debt securities, that gain would go to other comprehensive income, not the income statement. So it would change this number here. And that would become 6. All right? And it would change then the taxes, okay? And so forth onto your statement of stockholders' equity, because I've got the formulas worked out. That's if this had been missed and now you found it and you came back to put it on the statements, okay? So what gets a little tricky is what happens if we sell bonds. So this was an unrealized gain. We sell the bonds from ABC for $12, all right, in year 2. So this was year 1. Now we sell them in year 2. Now, What happens is when you sell the bonds, when you have a realized gain, it doesn't matter what the asset is you're selling, you have to record it, the gain on the income statement. So what is your realized gain? Well, 12 is what you sold for. You bought it for 10. So the realized amount is $2. That, okay, is going to go over here in year 2. So imagine that this, we've already moved on to year 2, and that this is 0 on year 2, or some other number from other things we've done. We would increase it by 2. And which should affect net income, tax expense, earnings per share, and so forth. However, one of the things that's happened is we recorded this unrealized gain last year here. So if we're in a new year, okay, then this 4.8 carried over to the new year. So that was from year 1, but now we're still counting it in this accumulated other comprehensive income. That's the point. These things accumulate. So you have this gain accumulated that you need to undo, otherwise you're counting it twice. Over here in the net income, and it's still in comprehensive income. So you're going to have to take it out in year 2 of the gain. So now you have the $2 gain in net income and your minus gain, if you will, if you want to talk about it, taking it out of comprehensive income or other comprehensive income. So that otherwise you're going to count it twice. Because if you look at this, the real increase is what? From 12 to 11. I mean from 11 to 12 for this year 2. All right? So we take the 1 out of here and we put the 2 over here. That's how you deal with it on a second year when you sell a debt security that is available for sale. If it's trading debt securities, that it goes on the income statement. All right? Just like stock transactions do. So that is the crux of what we did. There is the practice with the columns and building an income statement. With my explanation of how to do that, there's both a spreadsheet and a podcast explaining that.